good guy. Predatory angels, the train is leaving the station. AI for AI's sake, really well-defined investment thesis. Blow my mind. The best investors are often former founders. For us as investors, the opportunity is in the imperfection.
Matt, welcome to Between Meetings. It's great finally to have you on the show.
Thanks for having me. This is great.
You've gone from founder to investor, and I think definitely it gives you advantage. You have the empathy for the founders who go through entrepreneurship, but on the other hand, I think it also makes you too close to founders' perspective.
I think definitely the best investors are often former founders, so they have that empathy component. Obviously myself, I was a former founder. I've built several companies now, but I think when you get to the other side of the table on the investor side, I now have a fiduciary duty to be a good steward of capital to my investors, right? They're giving me their hard-earned money, they're trusting me to make investments that are in their best interests and ultimately return capital back to them in multiples, right? So for me, it's you got to really strip out the emotion. You got to look at things more objectively. It's one thing to meet a really charismatic founder. You fall in love with the product, you fall in love with the team, and then you want to do the investment. But then, as you start going through your diligence checklist, you start to see some red flags, or maybe there's gaps here, there's gaps there, and then ultimately you might get to a point where you can't make the investment for whatever reason. And I think, for me at least, the easiest way to do that on the investor side of the table is to have a really well-defined investment thesis. So having that mandate, knowing the types of companies we're looking for, the types of stages, geographies, traction, industries, et cetera, where I can objectively go through our diligence checklist, make sure that the company ticks all the boxes, and not just get wrapped up in the emotion of the deal or the charisma of the founder or the fact that I just absolutely love the founder. So for me, yeah, I think that's the big difference that I've had to work on over the years to strip out that emotional component, because I've sat in their shoes, right? I know what it's like to be on the other side of the table, trying to get money from people, trying to build a business, trying to sell customers. It's tough. It's incredibly tough. So as an investor, you want to extend that olive branch and reach out to them and try to help them where you can. But at the end of the day, you still have that fiduciary duty to your LPs. So you've got to do what's best for the venture firm and for the investors. Because ultimately, if you start to erode that trust, then it's going to be harder for us to raise additional funds from investors. Investors lose their trust in us, and then ultimately we're out of business too. So, and that's not good for anybody. That means less funding for founders. Means I'm out of a job, so that sucks. But yeah, just trying to be objective, having that well-defined investment thesis, and not being afraid to say no.
At Alike Venture Partners, what do you look for when you back in early stage startups, and what makes a pitch stand out to you?
So for us, because we're investing mostly in enterprise and consumer software, it's really never been faster, easier, cheaper to build some type of MVP, get a handful of customers, start generating early revenue. So for us, I really like to see a founder who's already built something, bootstrapped it themselves. Maybe it's a small team of 2 or 3 people, and then they come to us, and it's impressive. It's like, wow, you've built all of this with just 2 guys in a garage or a team of 3 people. That's absolutely fantastic. So red flag for me is when a founder comes to the table and doesn't want to start building until they raise capital. And I think it's really tough to do nowadays unless you're building very capital intensive hardware, robotics, biotech, or life science companies that require a lot of capital up front before you can start to monetize. If you're building a software company, come to me, show me what you've built, blow my mind with the amount of traction you've been able to build. One example, a company of ours that we invested in a few years ago out of Miami, they came to us with a dozen customers and 250,000 in annual revenue already before ever taking an outside penny from investors. So great discussion. Wow, you were able to build all of this just on your own with $20,000 that the founders put in. It's absolutely incredible. So that's what really gets me excited. Another example, a company, Christina, who's the founder of Edify, they're based out of Austin. A similar thing, she bootstrapped her company to $2.5 million in revenue before ever taking an outside dollar. And then when we met her and had the opportunity to invest in her first external funding round, I mean, it was an absolute no-brainer. Like, we know she can execute, we know she's an absolute killer, she's going to make her product or her vision succeed in the world no matter what, with or without my money. So we're either on the train or we're not, but the train is leaving the station and that founder's going to stop at nothing to make their vision a reality. So that's what I like to see, and that's what really gets me excited as an investor.
Mm-hmm. We talk a lot about the ecosystem in this series of interviews, and today is not an exception. What's unique about Calgary's, or maybe Alberta's, angel investing ecosystem, and where do you see opportunities or challenges for both founders and investors here?
I mean, it's come a long way. I moved here in 2013 from Toronto, and when I first came out and wanted to start angel investing and get more involved in venture capital, there really wasn't much of a startup scene at the time. Fast forward 12 years now, we have, Platform Calgary, Startup TNT, Innovate Calgary. We have all these great programs, accelerator programs. So it's definitely come a long way. I think a lot of the money is still concentrated in real estate and oil and gas. And that's just the Calgary ecosystem, right? That's where people have historically made their money out here. And you really can't blame them for wanting to invest in things that they know. So it's been a struggle, I think, for early stage technology companies. Like, we still have a pretty large funding gap at the pre-seed and seed stage, but it's getting better. Like, every day I have new people coming to me and knocking on my door and asking, tell me more about the technology investing and early stage angel investing. I'm interested, I want to get involved. People are starting to see more and more headlines like Slack or Shopify or other tech companies. Benevity is another local one here in Calgary, coming to market, and they want to get a piece of the action, right? So I think people are starting to realize that they want to diversify their portfolios. The government has helped out a lot too, with a lot of programs to help diversify the economy away from oil and gas as well. So that's a great move in the right direction. But ultimately for me, like, when I first started here in 2013 and wanted to start angel investing, like, there really wasn't much going on at the time. So I had to focus most of my networking and my investing south of the border. So I would join angel networks in Silicon Valley, Boston, New York, back in Toronto, Vancouver, more established venture capital markets, just to try and gain those networks and that experience and learn from sophisticated venture capital investors, kind of like an apprenticeship, if you will, and then try to bring some of that back to Calgary. And thankfully, over the past 5-6 years, it's continues to improve. I hope our government can maybe bring back some tax breaks for early stage investors and really help incentivize people to invest more into early stage technology companies, because ultimately it's a multi-decade transition process, right? We need, until we get more tech companies to realize exits, and then that mints the next generation of angel investors who then want to recycle their profits back into early stage technology companies. That's what it's really going to take to get the flywheel going and build a self-sustaining ecosystem. But we're definitely moving in the right direction. But myself as a startup founder mentality, I mean, I always want things to be twice as fast. So it's never going to be moving fast enough, in my opinion. But we're moving in the right direction.
You were an early investor in Lyft, which is extremely exciting. I'm not sure how many other investors are there from Calgary or from Alberta. This is the side question. Yeah. But what drew you to the opportunity? Where do you see the opportunity? And what lessons from that experience guide how you invest now?
I was very fortunate, right place, right time. I was at a venture conference and ended up meeting a group of people that were raising a pro rata allocation as part of the Series B in Lyft. So I was able to participate through that. And that was great because it taught me a lot of things about growth stage financing. Obviously, the company went on to do exceptionally well. They IPO'd in 2019. And my thinking around the investment at the time was, well, there's always room for a number one and a number two in every market, right? We know that, Pepsi, Coca-Cola, Air Canada, WestJet. So that was my thinking there. And then also at the time, if you remember, there was the boycott Uber movement happening. There was cultural issues happening at Uber HQ, and things. There was the boycott Uber movement happening. So Lyft was really emerging as sort of the good guy in the rideshare wars. So I figured, hey, this could be a really interesting opportunity. Obviously, yeah, like I said, the company IPO'd in 2019. That was a great experience because then all of a sudden you get shares in your trading account that you weren't able to liquidate for many years, and now with the click of a mouse you can go and sell your shares. So that was super cool. But in hindsight, looking back now, if I could do things a little bit differently, I probably would have hedged my position once it went public, because as early investors we're stuck with a 6-month lockup period. So you can't sell the stock for the first 6 months, and that's just to prevent people from flooding the market and tanking the stock price. So unfortunately, Uber sort of regained their momentum and their dominance in the rideshare market. So Lyft stock didn't really perform too well for the first 6 months. I think it was down close to 50% from its IPO pop. I still did well on my initial investment because I was in early enough. But if I could go back and maybe hedge that position a little bit, maybe with some put options or something, just to protect some of those upside gains, I think I would do it a little bit differently in that regard. But overall, yeah, it was a really exciting opportunity to be a part of. And again, right place, right time, just happened to meet the right people and was able to negotiate my way into the syndicate as part of that Series B.
That's pretty exciting. Talking about big names or successes, what are the big companies that you're really proud of that you are part of?
Similar opportunity with that same group. I also got into Pinterest relatively early. Similar situation as part of their Series B pro rata follow-on round. That was really cool. Again, like I wasn't a user of the platform. I had never used it. I had heard of it, but the big realization for me was one evening I asked my wife. I said, "What do you know about this Pinterest platform? I'm thinking of making an investment." And she said, "Oh, every bride in the world uses it to plan their wedding day." So that was sort of the light bulb moment for me. Well, that's a very large and global and lucrative market. So sounds like an interesting opportunity. And same thing, the company went on. They also IPO'd in 2019. So that was an exciting opportunity to be a part of. But as my experience grew, I wanted to do more and more earlier stage deals. So since then, I've significantly moved upstream. All of my investing now is seed and Series A stage companies, but some of those early opportunities were great because I got to cut my teeth a little bit, learn from experienced investors while not taking on the same risk profile that you normally would at really early stage, right? Like we already have companies that are at Series B, they're in market, they've got traction and customers. So yeah, it was Pinterest, go figure.
Perfect. Expanding on your experiences, when do you think founders should take angel money, and when it does make more sense for them to pursue VC?
I mean, if a founder is going to take outside money at any point, they're most likely going to start by taking money from angels, whether that's part of their first friends and family round or a pre-seed round. Luckily, we do now have a lot of VCs that are starting to dip down into the pre-seed stage and will invest at that pre-product, pre-revenue stage. But most of the VCs now, they want to see some type of product in market and some early traction. So most VCs are investing at seed and Series A. So for founders going to take outside money, you're most likely taking it from an angel investor as part of your first outside round. And my biggest advice to founders is, understand the terms that you're signing with an angel, because especially here in Canada, we have a lot of people that are new to angel investing, or maybe they used to invest in oil and gas, for example, but the structure of deals is very different for early stage technology companies, right? Because they're not generating cash flows within the first 6 to 12 months. So understand the terms that the angel is putting in front of you. And there's also a lot of really predatory angels out there that will saddle a founder with unfriendly terms, right? Like taking large portions of equity, multi-X liquidation preferences. I've seen term sheets or prior funding rounds where an angel has attached warrants or debentures. And ultimately that just handcuffs the founder, because if the company does well and then they go out to raise their first round from a professional VC as part of their seed or Series A, a lot of times the VCs, as much as they love the founder or the product, they might not be able to invest because the cap table is a mess. They don't really know what their ownership or dilution is going to be. Or I've even seen instances where an angel owns 55% of the company, right? More than the founders. So it's really difficult when you see some founders that maybe didn't understand the terms that they were signing early on. And I get it, you want to raise money, get back to building your company, and sometimes it's difficult to not just take the check and not really care what terms are attached to it. But talk to founders that are a few stages ahead, right? Talk to founders that have raised a seed or a Series A and ask them, like, are these terms standard, right? What do you think of this term sheet that I got from this angel? Or reach out to downstream VCs. Even myself, I help founders out all the time by reviewing term sheets from angels and other early stage investors. And I can tell you right away if there's non-standard terms in there, and if you're going to end up getting handcuffed as the founder. And that's ultimately not where you want to be. Some angel that is more concerned about protecting their downside risk than helping the company succeed, and with the mentality that how big could this get if everything goes right. And I think that's the mentality you need when you're investing in the venture asset class, not what can I do to protect my downside in the event that this doesn't work out. I think if that's the mentality of the angel, then they shouldn't be in venture capital, right? Go to public markets or private equity or later stage investing. But for founders, understand the terms that you're signing, and don't handcuff yourself for future rounds, because that could really make or break your company.
Mm-hmm. So you already start talking about some of the mistakes. So working with the founders, advising the teams, what are the big mistakes you see they usually tend to make, and how they can avoid them?
I think the biggest one that I see most often is an obsession with perfectionism, or trying to build a perfect product, or get something totally perfect before putting it out into the world. We see a lot of companies that are building in stealth, for example. So unless you're building, rockets like Elon, or some type of, highly proprietary medical tech device or drug discovery, if you're building a software product, whether it's enterprise or consumer, like, just get an MVP out into market, start talking to customers, get that early feedback, because that's going to go so much further and be so much more beneficial to the company than keeping things private and in stealth, and then only releasing the product once it's absolutely perfect in your mind. And from an investor's perspective, like, that's where the alpha is, right? That's where the opportunity is for us, is investing before it's perfect. If it was already perfect, then it would be a $5 billion company doing $100 million in annual revenue, right? There'd be no opportunity there for us. But for us as investors, the opportunity is in the imperfection, knowing that, okay, this is the roadmap, these are the key hires we're going to make over the next 18 months, these are the milestones we're going to hit, and if things continue to improve and we can get to, that perfect product 5-10 years down the road, that's where the returns come from, and that's where the alpha comes from as an investor. So don't worry about perfectionism, don't worry about investors thinking that, it's not good enough product, or there's things aren't finished, or there's not enough traction, because any decent investor will tell you that's where the opportunity is. We want to invest before it's perfect, because then we can capture as much of that upside as possible.
Looking to the future, where do you see the biggest opportunities for startups, and what founders should pay attention to in the coming few years?
Yeah, obviously everyone is talking about AI and ML right now. That's the big topic of the day. Obviously, it's a paradigm shift. I think AI is definitely here to stay. It's going to be part of our lives. It's going to be ingrained into every company going forward. But I also see a lot of founders that are sort of chasing fads and just building, AI for AI's sake, right? Just trying to get something out into the market. And I think that's a mistake. Like, don't go out and just build an AI native company because you think you can raise a bunch of money. You really want to be passionate about the problem that you're solving. You want to have experience with the problem. And I think for me as an investor, where I'm seeing the biggest opportunities right now are companies that have been around for a few years. They have a real product. They're solving a real problem for real customers. They have traction and revenue, but maybe 2 or 3 years ago, they got passed on by VCs because maybe they didn't quite fit that venture backable profile, or maybe their growth was a little bit less than a VC would like, or maybe their gross margins or economic profile wasn't quite up to par in terms of what we like to see from a typical venture scalable company. But now with AI, they've been able to completely change the economic profile of the business. And one example, one of our portfolio companies were able to reduce their customer service department by a factor of 8 to 1 just by introducing new customer service chatbots and automating a lot of that with AI. So, they were able to dramatically reduce their overhead, increase their margins, and the company grew 10x year over year last year. Whereas 3 or 4 years ago, they were growing 2.5, maybe 3x year over year. So I think that's where the opportunity is right now, not chasing the hype of AI for AI's sake companies, but instead maybe going back a couple of years, looking at some of those companies you passed on that maybe didn't quite fit the bill for a venture scale company, and take a second look, because founders are really smart. They're finding really innovative ways to integrate AI into their business, and I think it's time to take a second look at some of these companies from a venture backable perspective.
Matt, thank you so much for the insights. Thank you for the conversation. I really enjoyed, and I hope and I look forward to watch your work with Founders grow.
Yeah, my pleasure. Thanks again for having me.